Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Delivery to acquire 100% stake in Pune-based supply chain software company Algorithm Tech for a cash consideration of 14.9 crore rupees. The acquisition is likely to be completed by January 31st, 2023. Delivery will fund the acquisition through the proceeds raised from its 5,235 crore rupee IPO in May this year.
Better Place raises $14 million as part of Series C fundraise from several new investors as well as existing investors, Jungle Ventures and British International Investment. Better Place is eyeing an ARR in excess of $100 million in FY23.
The Ayurveda Experience, a D2C skincare and nutrition brand, raises $6 million in a new round led by Anicut Capital. Other investors that participated include Mariwala Family Office, Sharp Ventures and Singularity Ventures. The proceeds will be used to expand its footprint in North America, Europe, Canada, Australia and India as per reports.
Home decor startup The Artment receives an undisclosed capital in its seed round from Mumbai Angels. The brand will use the capital to launch SKUs in the US and scale its business in the American e-commerce market.
Xiaomi has started laying off workers in several units of its smartphone and internet services business, reducing its workforce by about 15%. The South China Morning Post reported workers impacted by the layoffs have posted their ordeal on various Chinese social media platforms, including Weibo, Xiaoxingmo, and Mamai.
US lawmakers have included a proposal to bar federal government employees from using Chinese app TikTok on government-owned devices in a key spending bill. The Senate last week voted on a bill sponsored by Republican Senator Josh Hawley to bar federal employees from using the ByteDance-owned short video app on government-owned devices.
Meta Platforms does not expect to seal its acquisition deal with Within Unlimited, maker of the popular fitness app Supernatural, before Jan 31st, according to a court filing seen by Reuters. Meta has agreed to push back the closing by 1 month or until the first day after the court rules on US Federal Trade Commission's preliminary injunction trial.
The Indian agri-tech sector is poised to become a $34 billion market by 2027, growing at a compounded annual growth rate of 50% over the next 5 years, a steep rise from $4 billion currently. Now, this is according to a report by investment banking franchise Avendus Capital. The report also finds that the agri-tech sector could create 8 or 10 unicorns over the next 5 years, with about 2 or 3 companies launching IPOs during this period. To talk about the future outlook of the agri-tech sector, joining me now are Pankaj Nayak, who is the Executive Director and Co-Head Digital and Technology Investment Banking at Avendus Capital. Also joining us are Satish Nukala, who is the CEO of Big Hut, and Prasanna Rao, the co-founder and CEO of Arya Collateral. Joining me from the Mumbai studio as well is my colleague Arundhati Ramanan. Pankaj, first to you, you expect the agri-tech sector to be a $34 billion market in the next few years. What is going to drive this kind of growth, and what subsectors do you see emerging in the process?
Yeah, I think the growth in this sector has just started. If you look at broadly the numbers, right, the whole agriculture market is 500 billion plus, and the technology penetration is less than 0.7%. If you look at all other sectors where technology is penetrated anywhere between 5 to 15%. So if you just go by what the next 5 years, even if that 0.7% get to 4 or 5%, it's a tremendous outcome. The second thing is, for all the food companies as well as eventually the consumers, I think the food traceability to the origin has become very important. So that's another factor that will drive it. And the third and then the most important thing is, all the tech disruptions are actually helping, farmer increasing his yield, reducing the wastage, and, also improving the supply chain efficiencies. And that is actually going to improve the life of the farmer, the outcome for the farmer, and eventually will help all the ecosystem. I think we are more bullish on the output side. The input side is largely, I think, more about the customer acquisition, and obviously you provide all the help and information to farmer in terms of how and what he should sow. But on the output side, obviously, the marketplaces, quality assaying, cattle trading, and more importantly, the supply chain management and the fintech along with it, which you can't ignore because ultimately there is inherent credit business in it. That's why the fintech also, I think, is going to be a large opportunity, which is along with the agri-tech B2B space.
Right. So you're more bullish on the output side of things. But hi, Satish, Arundhati here. Let me bring you into the conversation. While we're seeing increased internet adoption in rural areas, COVID has significantly contributed to this shift, and a whole bunch of tech entrepreneurs are now entering this space. But agriculture even today has less than 1% tech penetration. Do you think that the Indian agri-tech market is at an inflection point today, or are we sometime away from that still?
Yeah, absolutely. So if you see, we are at the cusp of massive digital transformation today, and it has never been, so encouraging. And we have seen significant transformation in the internet adoption in the rural hinterlands. And it is all triggered first by the entry of Geo and later on accelerated massively by COVID. And if you look at, COVID brought in a lot of structural changes in the behaviors of the farmers who are today accepting, and adopting various digital platforms. Even consumers, like you and me, are becoming quality conscious when it comes to choosing the food, right? So all this is leading to transformation in the entire Indian agriculture landscape. And secondly, COVID also led to streamlining of entire supply chain, right? So brought in a lot of efficiencies in otherwise fragmented and inefficient traditional supply chain. And across, of course, both input and output linkages, right? So just to summarize, all this coupled with significant technology intervention by all the agri-techs today in India, right? The entire agri-tech landscape and ecosystem is going through massive transformation. And it is also kind of replicating the success of agri-tech in the global market.
All right, Prasanna, thanks for standing by patiently. Let me bring you in as well. Do you concur with what Satish has told us? And also, the government has been taking several steps to boost online trade in agriculture. For instance, allowing the sale of insecticides to farmers' doorsteps through e-commerce. Are these kind of measures really helping?
No, absolutely. I completely agree with Satish, and also what Pankaj and Avendus have really put in terms of where the sector is moving. I think agri-tech as a sector is poised for really brighter and bigger things. And I think some of the initiatives taken by the government are extremely helpful. For example, what you mentioned about allowing e-commerce platforms to offer agri inputs and pesticides at the farmer's doorstep. I think as penetration of the internet and smartphones go up, I think these are the measures that would make sure that there is much larger adoption of these new age technologies in agriculture. So I completely agree with what Avendus has mentioned and also what Satish mentioned.
All right. So, Pankaj, if I could bring you back into the conversation, are agri-tech starting to see more participation from private growth investors already, or is that yet to pick up meaningfully? We saw this in the case of consumer tech-focused companies over the last 5 years. So, give us a sense of the deal activity in this space.
Yeah, so if you look at in the past, right, last 2-3 years, actually the scale of the agri-tech companies were much smaller. At whatever the outcomes of their largely fruits and vegetable space where actually some of their other challenges were there. So now if you see, there are already 18 companies that have crossed $100 million of top line. So now actually the space is getting really active. Also, the companies that are in this space have been built in last 2-3 years are actually built in very good capital efficiency, including two of my fellow panelists. And that will attract a lot of growth type of capital, because I think people are very focused on, in this sector especially, people are focused on whether you're capital efficient or not, because this is not a consumer sector you're going to go and acquire consumers and figure out how to make money later. So the people who are doing it properly, and there are as I said 18 more companies, we are seeing that a lot of traction and a lot of interest from growth stage investors, and we'll see a lot of activity in next 2 to 3 years.
Okay, then let me ask the people who are in the market perhaps to raise funds. Satish and Prasanna, first to you, Satish. Are you in the market to raise funds? Do you see more hectic activity in the private markets for the agri-tech sector?
So there is a lot of interest from global and domestic PE and VC funds. What they have seen, the massive, of course, disruption and transformation, which is a reality today in the agriculture by agri-techs. Of course, that's an event for us, and it's a continuous, kind of an exercise. And there is a lot of an interest as well. So we are weighing, various options to raise the funds, both on equity and debt for the growth.
All right, Pankaj, now the report says that IPO timelines for most of the agri-tech companies are between 3 to 5 years away. What kind of precursor would we see before this happens? Do you also expect some consolidation given the current macro challenges?
So it's straightforward, right? So companies are around 100 to 200 million dollars in their top line. Some of them are actually larger. I would say that probably people need to reach around $1.5 billion in terms of top line, because this is like a roughly 5% EBITDA margin, 3 to 4% profit margin kind of business. It's not like on a GMV basis people are going to make like 20% EBITDA. So at least people need to get $1.5 to $2 billion range for having a decent shape of IPO where you can actually be a reasonably liquid market cap. And that I think will take around at least 3 to 5 years for a lot of companies. And I believe at least 4 or 5 companies will be in that zone in next to 4 or 5. That's why I'm feeling pretty good about the IPO prospects of these companies.
All right, Prasanna, on that note, you'll have the last word then. One, are you in the market to raise funds? Two, are you exploring an IPO in the near future?
In terms of, I think as a business, we're the only profitable agri-tech in the country today, operating at a sizable scale. So, I completely would look forward to that milestone. With the kind of bottom line growth tied in with the higher, very stronger top line growth, we've been able to attract a lot of capital, both in terms of equity and debt. And we are quite certain that you'll see us in public markets soon.
So certain we'll see you in the public market soon. Well, gentlemen, Pankaj, Satish and Prasanna, we're completely out of time, but thank you so much for joining us on the show and shedding light on what agri-tech could mean for India in the next couple of years to come.
Yes, thank you.
Thank you.
Well, moving on. Frontline workforce management firm Better Place has raised $14 million in an extended Series C funding round from new and existing investors and hopes to use these funds to strengthen its tech enhancements and AI capabilities. Earlier today, I caught up with Praveen Agarwala, who's the co-founder and CEO of Better Place, to talk about this latest fundraise and their growth strategy going ahead. Take a look.
In this round, we are raising 40 million. We have existing investors as well as some of the new, like Macquarie Capital, Side Partners, and so on. And so far, we have raised more than 80 million. This happens to be, this round happens to be our largest round, as well as largest in this segment here in India, in the given situation.
Okay, given that this is your largest fundraise so far, you say, how are you going to be using these funds? I know part of your press release says this is going to be used to enhance your tech capabilities, but you're also looking to enter new geographies?
Absolutely. I think one of the key things that we focus on is how do we create technology that will enhance the value for our customers and end users. So that's one thing where we will continuously invest. And the other thing that we're also looking at is geographical expansion, right? We believe that this is the time that we go into Southeast Asia and perhaps in GCC countries as well. We will actually start launching sometime in early January in Indonesia and as well as in Malaysia, and then expand into Thailand, Philippines, Vietnam, Korea, and other parts of Southeast Asia. And that's where we'll use the capital.
So will some of these, expansion plans that you have in geographies outside of India be fueled by inorganic opportunities? Are you looking at more acquisitions?
So Ritu, what we also believe is that if you go to a new country like Indonesia or Malaysia, you also have to bring in excellent team. You have to understand the culture and something which is existing there, right? So we believe that it can be a partnership and inorganic model, and we are working towards that. You will hear from us soon.
So when you say partnership, you're looking at more M&A because you've already done 4 so far. How have those panned out, and what is really the strategy from here on?
So if you look at overall last 12 months, we did 4 acquisitions here in India, and those have created immense value for our customers as well, because they want to have one comprehensive solution, right? And that's what we believe in. And we continue to do that. We will continue to acquire here in India as well, mostly focusing on product, while we have a good customer base, looking into new products like fintech and others. And in other geographies, we'll look into more expansion into the customer base itself, right? We believe it will be a combination of both organic and inorganic growth. While in some country might be we go inorganic and take the same product in the other country. For example, have something in Indonesia and go to Thailand, more organic in nature, right? So that's how we are thinking.
So it'll be a mix of organic and inorganic growth. Praveen, last time we spoke, you said that you were closer to profitability. Now that we're speaking a few months later, how much closer are you, and how are you looking to end this year, both in terms of profitability and revenues?
So from a revenue point of view, in FY22, we grew 5x from the previous year. This year we are tracking more than 3x growth already. We'll be north of 110 million by end of the year.
Okay.
From a profitability point of view, at CM1, CM2, we are already profitable. Whatever money we make, we actually reinvest in the company. But at the EBITDA level, we are targeting to be profitable by end of next year.
End of next year, calendar year.
That's right.
Okay, just a quick last question. Since we're entering 2023, what are the trends emerging in the gig economy? Any trends that you could share with us?
From a trend point of view, if you look at, there are three things that we look at overall, right? One is that most of the people wanted to be only in gig economy in past, right? Now that is changing. People want to be in both permanent job as well as doing part-time gig, right? So that's one thing that we are seeing dramatically happening. The second thing is that most of the organizations wanted to tap into the same resource all the time, right? And that was causing a resource shortage. So what we have realized is that they all want to create new resource pool, right? So organizations want to create a new resource pool while the individuals also want to come into the new opportunity, right? So we have created this digital university program along with the employers where we can upskill people and create a larger resource pool. The third thing that we really want to create is bringing more women into the gig economy as well, right? And most of the companies, they have the ESG target, right, which is also about social and governance. And we believe this is a huge, huge opportunity and nobody has really tapped into. So that's a shift that we are seeing, and hopefully we'll be able to contribute and bring this from 3% to 20% over the next 5 years.
Welcome back. You're still with us on Startup Street. Tier 2 and 3 cities cornered a greater share of India's e-commerce market over the last 12 months, with easy access to large assortments of products, prompting shoppers in under-penetrated markets to turn to online purchases, according to a report by Unicommerce. Now, sample this. The e-commerce market share of Tier 3 cities grew from 34.2% in 2021 to 41.5% in 2022. While Tier 2 cities rose from 19.4% to 21.4% during the same period. Now, at the same time, market share of Tier 1 cities dipped from 46.4% in 2021 to 37.1% in 2022. The report added, now that's not all. The year saw a change in consumer behavior and preferences as buyers adopted both offline and online modes of shopping, but online commerce continued to see a bigger growth momentum. The sectors that did well were the beauty and personal care sectors, as well as eyewear and accessories. And joining us now to decode this report is Kapil Makhija, the CEO of Unicommerce. Kapil, thank you so much for joining us on the show today. So let's address one of the top findings of your report, the emerging dominance of non-metro buyers in e-commerce. It has well and truly moved beyond larger cities to Tier 2, 3 and beyond. Talk to me about this Bharat opportunity. What has led to this growth and what's the opportunity you see over here going forward?
Sure. Thanks for having me here. I think we saw at the start of the pandemic, we saw this opportunity getting created where Tier 2, Tier 3 consumers were shopping online. I think that trend persisted primarily due to three factors. One is the consumer started to get access to larger brands at affordable prices. Second is the ecosystem got created in terms of logistics, warehousing, and technology to be able to have these brands access. And once the brands saw growth coming in from these pockets, we saw more and more brands investing on Tier 2, Tier 3 domains to make sure that they're able to drive growth. So these three factors came in together, and we've seen fashion and beauty personal care categories do fairly well in these, and we expect that other categories will also follow suit. The same growth trends that we saw in metropolitan cities in the earlier years, we will see very similar trends coming in from the Tier 2, Tier 3 towns as well.
All right, and you spoke about those sectors. So another finding of the report points to the fact that Indians actually like to look good. The beauty and personal care witnessed sharp growth in 2022. What's the beauty and personal care space going to look like in 2023? There have been so many D2C beauty and personal care brands that have popped up. Will we see consolidation in this space? And what are the other categories that are expected to do well going forward?
Sure. So beauty and personal care space has definitely seen an impressive trajectory of growth over the last 2 years. We expect that trend going forward. So there is, because what these brands were able to do is get great products at affordable prices and at the convenience of a click. And there were so many niches that were available that there were spaces available for a lot of brands to come in. And that's why we've seen so many launches coming in. Now there is a lot of focus of these beauty and personal care brands to work towards unit economics, work towards profitability. So there may be some consolidation, but largely driven by the fact that some of the larger conglomerates, and we are seeing some of that action already, that some of the larger conglomerates are acquiring some of these D2C brands because they are realizing the success of what online first or digital first brands have shown by going D2C, and some of these acquisitions are happening so that the traditional first brands or large conglomerates can actually be closer to the consumer and reap the benefits of the data as well as the trends that we are seeing that are evolving at such a rapid pace.
Absolutely. And these D2C brands are increasing their presence across the e-commerce landscape and showing a marked preference for driving user engagement and sales through their own brand websites. They have spent the last 2 years investing heavily in technology to build a strong supply chain ecosystem and drive traffic to their brand websites. And despite the strong revival of physical channels that we've seen, overall online volumes grew 36.8%. Will this be a trend that continues? What do customers prefer at this point?
Sure. So e-commerce, I think, will continue to outpace offline retail growth because still the relative share is still early double digits for them. See, for a consumer, it doesn't matter. Consumer has always been omni-channel. I think they just want great products, great service at a great price. So whatever is able to offer that, the consumers will go after that. In fact, because even in spite of revival of physical channels, e-commerce continues to grow strong, which indicates that there is a fundamental shift in consumer buying behavior, and they want to. E-commerce has become a inherent part of retail, and that's why brands are adopting now omni-channel strategy, where offline first brands are going online and online first brands are actually going offline. And we are seeing that consumer was always omni-channel. Now we are also seeing brands going the omni-channel route as well.
All right, and speaking of that, omnichannel, like you said, has become the go-to strategy for all brands. So what does the road ahead look like? What segments will benefit from an omnichannel presence?
So in terms of segments, fashion has been an early adopter of omnichannel, as like it is a mature category, and the other beneficiary has been eyewear. Omnichannel as a trend started to pick pace post-pandemic, and we are seeing in going into 2023 also, we see a lot of offline first brands investing in their D2C/online strategies, and it is becoming a core part of their growth strategy. And similarly, online first brands, because e-commerce is still, as I mentioned, early double digits, right? So therefore, their growth strategy, they realize that they have to go offline. So we are seeing these worlds converging, and thanks to the technology process and overall ecosystem that's available in terms of logistics warehousing, I think we are very bullish that omnichannel will be a go-to strategy for all brands alike, whether it's offline first or online first, because ultimately the consumer happens to be always omnichannel.
All right, so omnichannel is going to be the go-to strategy irrespective of any of the segments. But also another interesting trend that you'll notice is that reduced returns have also helped build a stronger business, as they've reduced by about 1.6% to 15.8% in calendar year 2022. So what has led to this? What has changed that even returns have gone down now?
So returns is an inherent part of e-commerce, right? This is to drive consumer behavior. But over years, we have seen brands consistently investing in ensuring that returns reduces and overall consumer experience increases. And there have been a lot of technology interventions also. Returns of two types in e-commerce. One is an RTO, wherein an order gets undelivered to the customer. The second is customer-initiated returns, where a customer accepts a product, tries it, but probably doesn't like it and wants to return it. On both counts, we have seen a reduction. Predominantly, we are seeing a lot of nudges from the brands to convert COD orders, which is cash on delivery orders, to prepaid, because returns are typically higher on cash on delivery orders. Second is technology interventions. For example, technology today can predict the RTO propensity of a particular order, and that can warn to the brand that maybe you want to double check with the customer whether they will want to receive it or not, and then maybe nudges on WhatsApp that this is the delivery time, would you want to reschedule it if you're not available? So some of these technology interventions plus consistent focus by the brands has helped bring the returns down over the years.
All right, Kapil, some interesting trends there. Thank you so much for joining us on the show and decoding what e-commerce looked like in 2022 and what we can expect in 2023.
So thanks for having me.
And with that, it is a wrap on this edition of Startup Street. From Ritu and me, goodbye and many thanks for watching.